Hey TMFG community, John Yonge here with Carlo Cancino. In today's episode of Ask TMFG, we're going to be taking a look at how can you optimize your financial health. Remember, if you do enjoy our content, like, comment, and subscribe to the YouTube channel. We love doing these videos for you. In today's episode of Ask TMFG, we're going to be taking a look at how to optimize your financial health. And this is going to be our last video for November, which is Financial Literacy Month. So just like with your regular health, you go to a doctor, you get yourself a checkup. This is going to be very much the same thing. What can you be doing now to optimize your financial health? So Carlo, why don't you get us started?
Thanks, John. If you've been watching our videos, you'll know that we've talked about debt before. So one of the ways that you can improve your financial health is knowing what debt is good and what debt is bad, because debt is necessary.
Yeah.
And if you're carrying debt, some of it can be good and some of it can be bad. So what are some examples of good debt? Well, I think the examples of good debt would be ones that are going to purchase an asset or purchase something that is going to provide income. So for instance, a mortgage on a piece of real estate, that is good debt. That piece of real estate is either going to be your principal residence or an income property that's going to provide rental income or some form of business income. Another good debt would be debt taken on to buy a business. And again, the business is going to be put in place to earn income. And lastly, another good form of debt is going into debt for education. And that way you are actually investing in yourself, in your intellectual capital. So taking on debt for those three things, good debt. Bad debt, as you can imagine, would be consumer debt, whether it's credit card debt, consolidation loans, things that you're purchasing that are more for utility as opposed to earning income. So those are the differences between the two. If you know you've got some forms of debt, try to minimize the bad debts and increase good debts if you have to.
Yeah, and the bad debts, right around the corner, we do have the holidays. So we know a lot of people can get into spending maybe a little bit more than you want to. The heart's in the right place. You want to buy gifts for other people. But at the same time, you got to make sure that you are doing it well within your own means. And that actually leads us to our next point. And it's budgeting. And if you kind of look at it from two ends of the coin, right? If you're pre-retired, you're in wealth accumulation phase. So you're trying to grow your net worth up until retirement. Or if you're retired, you're trying to keep your net worth afloat while you're drawing income from the overall portfolio. So I'll think more from the pre-retired stage right now. And you should be trying to build up your net worth, as I did mention. And we typically like to use the general rule of thumb of about 20% of gross income going towards your net worth. So that'd be paying down debt that Carlo had originally mentioned, or saving towards long-term growth. So if you think you're making $100,000 a year gross per year, you should be trying to get $20,000 of that per year towards long-term savings or towards debt repayment. If you stay on that target, you should generally get yourself in a pretty good situation come retirement time. But if we think from the opposite end of the coin, now we're thinking more for retirees. And again, we use another general rule of thumb for retirees, and that is how much you withdraw from your portfolio. Typically, the rule of thumb is about 4%. If you can withdraw 4% or less from your portfolio each year, it should leave you in a pretty good situation. Reason being there is we're trying to not withdraw too much, and we want to have the growth or the accumulation of the portfolio exceed that of withdrawals. So 4% is a number that your portfolio should be able to beat over the long course of time. So those are two general rule of thumbs that we consider when thinking about budgeting that you should institute in your daily lives as well.
John, that reminds me of a conversation we had the other day. We both had client meetings, and we talked about it. It's common sense. Financial planning is easy. Budgeting is easy. Yeah. Make sure that you're spending less than what you're bringing in.
Absolutely.
And as simple as it sounds, it's very difficult for people to execute. You're in your neighborhood, you're looking what the Joneses are doing next door, and you're wanting to keep up. But if you're looking at the income that's coming in, spending within that limit, you can ensure that you'll be financially successful over the long term.
Yeah.
So we talked about budgeting. John talked about that 20% that should be going to increasing your net worth. Third thing I was going to mention was savings. So what you should be doing is just the way that you allocate funds for your regular expenses, whether it be your utilities, your property tax, your groceries. Part of your ongoing expenses should be a savings plan. Treat your savings like a bill payment.
Yep.
and as though that you can't go a month without putting money aside for savings. Once you look at it as an automated bill payment, you'll never miss out on that consistent investing on a monthly basis. So treat your savings like a bill that has to be paid every month, and you'll find after years that depending on how it's been invested, it's going to accumulate and add to your income sources in retirement.
Yeah, absolutely. And when it comes to saving, that money is going to end up getting invested for long-term growth and long-term accumulation. So that really leads to our fourth point, and making sure that where you're putting those savings and the investments that you're choosing for those savings are the right ones for you. Now, to your point, don't look at the Joneses. Everybody is going to be different in terms of risk tolerance, time horizon, and those are the two main factors that we want you to consider. Whether you're pre-retired or into retirement, time horizon is going to be a very important part of it. You have a long-term time horizon, naturally you could just take on a lot more risk. You have a shorter-term time horizon, you're going to be a little bit more conservative with that. And that's just generally how we treat accounts. But then that doesn't even take into consideration what's your personal risk tolerance level. I think both of us, we have a pretty aggressive risk tolerance, just understanding the industry as a whole. But there's going to be some people that don't want to see any sort of fluctuations going on in their accounts, and it eats away at them, it eats away at their anxieties. So understanding what your personal risk tolerance is, as well as the time horizon, is going to be getting you into the correct portfolio. At the end of the day, our objective for you is to get the highest rate of return possible with the least amount of risk. And that should be your objective as well in how you construct your portfolio.
So there you have it. Those are our 4 points about trying to optimize your financial health. I know that November is Financial Literacy Month, but we should just look at educating your financial literacy or improving your financial literacy every day. So we've talked about it in the past. Watch our videos. Give us some feedback. Let us know. Are you finding them interesting? Are you finding our videos helpful? Provide us with some comments, or just let us know that you're enjoying what you're seeing and give us a like. Until next time, I'm Carlo Cancino.
I'm John Iaconetti.
And this has been Ask TMFG.